யாருக்கு அதுல இங்கிலீஷ் தெரியும்?
Can you?
அது வரைக்கும்
Request anyone who is not speaking kindly switch off their microphone that the discussion is not disturbed. I'll request our Executive Director and CEO, Mr. G.J. Memen, to give a small brief and setting up of the context why this webinar has been organized.
Thank you, Sri, and thank you everyone for being here for this webinar on QMR. I'm sure all of you knows what is QMR. It's a quarterly microfinance report which we bring out every quarter with insight from the credit information company as well as insight from the data collected directly from the microfinance institutions. As you know that Bharat Microfinance Report is a report which Sa-Dhan has been bringing out for the last several years, maybe more than 20 years now, and which gives a sectoral picture about the microfinance sector as a whole. It gives information about the microfinance institutions, their activities, SHG bank linkage program. So entire thing, it's a comprehensive report, and that is what that's why it has got a good recognition across board. Even RBI refers to it, government refers to it, Nidhi Aayog refers to it. In fact, if you see the couple of years, last year, the previous year, the RBI also, sorry, the government of India also referred in their document taking paragraphs from Bharat Microfinance Report. So this Bharat Microfinance Report is basically a report at the end of the year. It gives an overall picture for the entire year. But we also felt that probably there should be an update about the quarterly performance. So for, I think from 2015 onwards?
Yeah, yes.
From 2015 onwards, we had been also bringing out a quarterly report and quarterly monitoring report. Welcome, Vinit sir. Welcome. Good afternoon. Thank you. So this quarterly microfinance report has been a kind of a, I would say, supplementary to the Bharat Microfinance Report, which is brought out at the end of the year. So every quarter you get an insight about the sector, the activities of the different institutions, different activities. So that is how the QMR has been there. And we have been sending to various and I'll tell you, many people really look forward for that. Even today, I was, the SIDBI CGM was asking me whether the QMR for the fourth quarter is ready or not. And he asked me for a copy of it. In the sense, it is also getting widely recognized, and people feel that it has got some value in that. So far what we had been doing is that we had been sending these copies to various stakeholders, various member institutions. We thought that probably we can also have a discussion around that and also get some more deeper insight into that. Maybe some of the experts who can also give some more their insights about the numbers which we see. Otherwise, it is more of a numbers only. So what this number speaks, what are the things we have to take care of, what are the things we should not be doing. So some more insights about that. We thought it can be done at the time of release of the QMR by organizing such kind of a webinar where we can bring in the experts and their views also can be taken into account. So right now we have 3 experts among us. One is, of course, Mr. Karthik Srinivas. He is from ICRA. He would give his perspective from a rating agency and how he sees these numbers. Of course, we have 2 veterans from our own fraternity, our own industry. Sri Vinit Chatri from Sa-Dhan, MD and CEO of Sa-Dhan, as well as MD and CEO of Muthoot Microfinance Sadaf. Both are very, what you call, highly acclaimed and respected persons in the industry. Their views are definitely of great value. So I thank all 3 of you for being here with us and giving your perspective. We will be giving you a perspective about the sector and about the numbers which we are now presenting. Of course, I feel that probably we should have done it a little early, and maybe this being the first time we are doing it, it has been done a little late. Next time onwards, we'll try to make it a little more early so that these insights will be made use of by the member institutions in a better way. And we'll also try to bring in maybe one credit bureau to present some of these numbers so that they will also be able to give their insights about it also. So with this, I first of all compliment my team for organizing this kind of a webinar and this is for the first time I said we are doing it, and we hope to do it in a much better way in the coming days. So I thank my team and thank everyone who have joined this webinar, and especially our speakers, all three of you. Thank you very much and welcome to this today's webinar. Thank you.
Thank you, sir. Now I request our colleague, Mr. Sunny Koshi, to give a brief highlights of the report.
So I hope the screen is visible. Is our screen visible?
Is it
It's visible now.
Yeah.
Yeah, so we'll be briefly presenting the
Yes, sir.
highlights of the quarter microfinance report. So this is the sector at a glance. Like the portfolio as of March 25 stood at 3.82 lakh crores. It had registered a year-on-year degrowth of almost minus 14%. In terms of the market share, the NBFC MFIs were leading at 39%.
Can you put it on slideshow? And I think you're still there on that first slide is what we can see.
That means it does not show. No.
Just give us a minute.
Put that on a PPT mode, please.
It is on PPT. Yeah. Now is it visible?
And
Yeah,
yeah,
now-
no.
Yeah.
Yeah. So in terms of market share, the NBFC MFIs were leading at 39%, closely followed by the banks at 32%, then SFBs at 16%, and NBFCs at 12%, and others occupying remaining 1%. And similar pattern was observed for the loan accounts also, which stood at nearly 14 crores, 13.99. It had also registered a year-on-year degrowth of minus 13%. And here also NBFC MFIs were leading in terms of market share. The disbursement also had declined by significant amount of minus 26%. The total amount disbursed during the year was almost 2.86 lakh crores by all the micro lenders, including banks, SFB, and NBFC MFI. In terms of trend of PAR, if we see over the 2 years, from March 23 till March 24, it was gradually coming down. The PAR under various buckets, 30, 60, 90, and 180. But slowly it again began to pick up and it reached PAR 30, including the 180 part, it reached almost 19%. So this could be attributed due to like multiplicity of factors like decline in portfolio, decline in disbursement, field level issues in various states. So these are the top 10 states in terms of portfolio and loan accounts. So the top 10 states almost accounted for 84% of the industry portfolio, and similar pattern was observed for loan accounts. So this analysis we have done based on the self-reported data received from 140 micro lending institutions. So we are just presenting some key highlights like the number of branches, number of staff employed according to different size-wise categories. So just the branch was, I think, 26,272 as of 31st March 2025. And the very large MFIs, they occupied almost 65% of the total branches. And the number of staff, it reached 2.23 lakhs, out of which the field officer also again occupied 65%. Yeah, the very large also here held the largest share, close to 64% of the total staff. Here the staff productivity, we present some ratios such as APCO, GLP per field officer, and disbursement per field officer. So the APCO for the industry had come down. It was 315 per credit officer, and it had declined across all the size-wise categories. Here we are presenting 4 size-wise categories. The small represents GLP less than 100 crore. The medium is between 100 to 500 crores. Large MLIs is between 500 to 2000 crores, and very large is about 2000 crores. So the APCO had declined across all size-wise categories. Again, the GLP per field officer that had also declined across all size of MLIs, as you can see from the graph. The disbursement per field officer had actually increased for medium and large MLIs and had decreased for small and very large micro lending institutions. So this we present like the cost structure and interest rate. So the cost of funds had actually overall come down slightly to 11.4%, and it had increased for small and very large MLIs, while it had decreased for medium and large micro lending institutions. While the operating cost had increased for all the MLIs, the operating cost was 7.89% and it had increased slightly from the previous quarter. Even the interest rate charged to the microfinance clients, it had decreased slightly to 23.69% compared to the third quarter. And it had declined for the very large micro lending institutions and small micro lending institutions. And it had increased for medium and large micro lending institutions. These are the profitability ratios compared to the previous year. So the ROA and ROE had significantly declined across all size of MLIs compared to March 24. The ROA was minus 1.17 for 140 MLIs and ROE was minus 2.99%. These are the breakup of the different types of MFIs according to the legal forms. So we had received information from 72 NBFC MFIs, 18 NBFCs, 16 Section 8 like that. And according to size-wise category, we had received major information from the small MLIs, 74, then 32 medium-size MLIs, 18 large MLIs, and 16 very large. Yeah. So we had also got information from 9 SFBs. So we'll be sharing that in detail in our quarterly microfinance report.
Yeah, Sadaf sir.
Yeah. Yes.
Yes, sir.
Yeah, so Gigi sir, I had one broad comment on the way we should compare these numbers, to be very honest, right?
Close, close.
If you can hear me.
Yeah, yes.
Yeah. See, the average ticket size or the disbursement per borrower actually is a function of geography where you are present, right? If you're in South, you are somewhere, it's not about the size of the entity, it's the need of the borrower, the general trend of the market. When it comes to OPEX, of course, the cost of funds, or let's say the customer per number of borrowers, customer per borrowers. This, of course, I do agree, depends upon the size of the entity because that is where the scale benefit or probably your focus in terms of your stage of evolution depends. If you're a 25-year-old microfinance, you will be different from a 10-year-old microfinance and a 5-year-old, and therefore the size of the AUM matters. And ROA and ROE cannot be averaged. You should not and not try it also. That does not make any sense because it's not about averaging, it is individual entity. I mean, that is what I thought I would convey that, we need to define these two different things. One is customer angle, which is about the ATS. One is the operating angle, which of course depends on the scale. And then ROA and ROE, we should ideally avoid averaging is my limited view, sir. I will stop here. I mean, Sadaf sir, please correct me. And I'm open to views.
No, I totally agree with Vineet. I think from an ROA, ROE perspective, you can show how many companies are above 1% ROA, how many companies are below 1% ROA, or how many are touching 2. I think that would be a good representative, and then you want to cut that into whatever size that is different, but I think that will be better because as an industry, I think it gives a very different picture. One person making a huge profit, and then the ROA kind of changes, and the other smaller ones are struggling and they are not even breaking even. Then it shows that the industry is on an average profitable and stuff like that. So I think that will be misleading. It'll be better to show how many, like 1%, how many 2%, how many 3%, and how many below 1% or below zero as well. So that will show a clear picture that it's not as if the every company is making profit. There are companies who are yet to make profit and they are about to break even. I think that's a fair point. Also, on the count of staff, I think that is the simplification of an average in terms of count, because if you look at in a year, there is a huge attrition that happens in microfinance industry. So we are taking disbursements of certain month and count of staff of certain month and dividing, but during the period, a lot of new guys would have come, a lot of guys would have gone out. So it doesn't really reflect anything in terms of productivity, to be honest. Because the attrition and everything has an impact, and also, as Vineet said correctly, where you're operating. So, for example, productivity in places like Karnataka today would be absolutely very low, but at
Right.
other places it will be higher. So it does not really show the true color. It'll be better to have a state-wise kind of a thing so that we can say that, okay, yeah, people operating in this area having this kind of productivity. I think what I was also looking, and I have seen that in that data with credit bureaus, some of the credit bureaus have shown that what is the impact of the three lender, four lender exposure. I think that is where what Sa-Dhan has recommended in terms of lending caps, in terms of 2 lakh rupees or whatever the lending caps is there. I think how they are helping the industry to come back. I think a lot of reduction in this AUM from where we were in 4.4 lakh crore to now 3.75 or 3.6, wherever we are, is also because we have not deliberately given loans to overexposed customers. So that attrition is actually a good attrition in a sense
Correct.
for the portfolio. It's not necessarily bad. So I think that also needs to be shown. And at the same time, I think what we are incrementally doing, incrementally disbursements in which direction they are going, I think that will be good to look at. Collectively, if we see, of course, the quarterly numbers are subdued. And this is also because of the not only because of availability of fund, but also because lenders are being cautious about lending in certain areas. So I think both things are combined. I
Correct. I
think
mean,
strat
actually, you're right,
yeah,
Siddharth. If we can begin this report by absolutely adding the cause and therefore the effect. For example, we are reducing the number of lenders, so we can show the decline in number of C3, C4. You can
yeah,
actually kind of also get from bureau the ticket sizes in terms of more than 1 lakh. They have this breakup of ticket sizes in which you can actually see that the industry is trying to come down and have new customers more coming in. All that in perspective, this is how the output is. There's a reason why this is happening. It's not just because the market is not there, like what you said, Siddharth. You're absolutely right.
yeah. So I think these are some of the point that we need to highlight. I think overall, I think this is a good start, and of course, this is a report that has been looked upon by various regulators and key stakeholders. But we also need to add what exactly are they looking at in terms of the trends post what we have put in as regulations or SRO level checks and balances. So I think it'll be good to add one or two slides on that.
Right. Thank you so much. I think, in fact, these two are very, very valid suggestions, and we definitely will be taking this into account for our further reports.
Currently, in the detailed report, we are mentioning the percentage of borrowers with the outstanding bucket and the lender bucket. We haven't put this here, but in the detailed report, it is there.
Yeah, I think especially on the ROA, ROE slide, you should work on because the averages are misleading.
Very right.
Sir, actually, if I want to know from you, ROR instead of giving percentage wise, if you give me a portfolio size wise, say for example, 1,000
No, no, no.
half.
Range wise.
Range
Incorrect.
And
Keep
that,
those with less than one, those 1 to 2, like that. It's okay.
Think about it. All we're saying is don't make it averages.
Yes, I
Especially when
agree.
Karthik is around, don't make it averages.
You can't make it.
Mhm.
I fully.
Sir, it make more sense. We'll make these changes in the next report for sure. I'll thank you both the sir for these suggestions. I'll request Sadaf sir to share his views on the sectoral status and also in the view of current changes in the sector.
Yeah, I think not very different to what I said. I think something I can tell you very clearly the initiatives that have been taken by the SROs, whether it's Sa-Dhan or MFIN, I think it was timely. The regulations that have been put in place in terms of number of lenders and also a cap on the overall exposure to the borrowers are definitely showing a very, very clear trend that people who have higher delinquency belonging to a multiple exposure norms. And I think slowly, gradually, these numbers are coming down. The portfolio attrition we have seen is more in the higher bucket segment where the customers are having 4 or 5 lender exposure. So that is where I think the reduction in the portfolio is coming, so which is good. That is the first take that I would give. The second trend that I have seen is that at the same time, the average ticket size for certain lenders have gone up. And the average ticket size, if the customer is having only one lender exposure, then that whole amount is being offered by one lender, almost like 1 lakh, 1.5 lakh is being lent by that lender. So I think that trend is also there. Overall, there has been significant amount of write-off. If you look at the credit cost across the industry, the average credit cost is around 8%, which is significantly high as compared to any other event that we have seen in the past when there was COVID. There were credit costs went up, but the peak was somewhere around 5.5%. But this time around, it has gone much, much higher, and which indicates that this is not such a small event. It is a event, and it has, of course, lasted more than what usually a event lasts in microfinance, maybe 2 quarters, but it has been more than a year, and it still continues to pain. That is one thing. But incrementally, positively, if you look at barring the Karnataka crisis in terms of the Karnataka legislation, the portfolio has shown improving trend. The customers who have been lent after the regulations that have been imposed by SROs, the delinquency among those customers is relatively lesser as compared to the customer who were lent earlier. And this is quite evident from the portfolio and the asset quality reports that have been published by various credit bureau. That is very important. I think the other thing from the advocacy side, Sa-Dhan has been able to, and both the SROs have been able to make the voice heard to the regulator. As a consequence, we have seen that regulator has liberalized the policy where there was a restriction of 75% qualifying asset. It has been reduced to 60% qualifying asset, which really, really gives a room for an microfinance institution to innovate. So it is a time where I think industry must develop the capacity to look at customers holistically and ensure that they are able to little bit diversify, but at the same time ensure that they are able to maintain their asset quality mix so that in any event or any crisis, we are able to kind of sustain and there is no pressure on liquidity. I think a second step that SROs have been effectively been able to take is they have made sure that the liquidity concerns have been highlighted to all the concerned authorities, be it Ministry of Finance, uh, be it RBI, be it the development financial institutions like NABARD and SIDBI, that definitely there is a need of liquidity, not only at the top of the industry in terms of the large MFIs, but also at the bottom of the industry, which is very, very necessary. And I'm happy to inform you that yesterday that our DFS had held a conference of NBFC symposium in which MFI was a topic which was very widely discussed, and they have assured that they will take all the necessary steps to ensure that there is enough liquidity and also ensure that the contribution to the growth of the country continues to be strong from MFIs and NBFC sector. So from that perspective, I see a very, very big change in momentum. Till last year, there was pressure on growth. If you were growing in an anywhere excess of 15%, the regulator was coming hard on us, and they were asking that you need to slow down. But now I think that there is a push to ensure that we grow, but at the same time, it is also very important that we grow in a responsible manner when the platform has been given to us to diversify. We not only grow by leveraging on the same customer, but we also grow by looking at other products that we can add to our company to make it a stronger asset quality mix. I'm very aware that Karthik is here, and as a rating agency, he's listening to us. I'm sure he can also give a perspective that if it's an entity which is well diversified in terms of its portfolio mix within the regulation, will enjoy a better rating as compared to a monoline entity. So I think it is in our interest that we look at growth not only from a perspective of leveraging more on the same customer, but looking at more products, a little bit more diversified approach to growth. I think the time is right. The quarter one is usually a slow quarter, but it has been, as compared to what it has been in the last financial year, a slightly reasonably okay quarter. And delinquency trend is holding up. One thing that I have seen and I have done the cuts on that myself. I have seen the 2014-15 election in Bihar. I have seen the 19 election in Bihar. In both occasions, there was no impact on the portfolio quality. So I'm not too sure what will happen this time, but keeping our fingers crossed, if the trend continues, there should not be any impact on the portfolio quality. But having said that, I still want to say that Bihar being the largest market for microfinance now, for MFI industry, we have to be ultra cautious in that market because anything happens in that market will impact the industry in a big way. So that is where we are. In terms of Karnataka, things are improving. In terms of what I can say that as far as our portfolio is concerned, things are not further deteriorating. It's a stable collection, and incrementally every month it is improving. And I'm sure as the liquidity in the market improves and more cash flow for the borrower comes, it will further improve. In Tamil Nadu, there has been no impact of the legislation. There was very, very minor impacts in certain areas, but overall, there is no impact of the regulation and things are moving normally as of now. We wish that it will continue in the same manner. I think the only challenge remains in certain pockets where there is activism, especially in Bihar. I think that we need to deal with and be cautious about it. And if we continue to engage with the customer and underwrite the customer better, I think we should be able to avoid. The most important aspect right now that everybody is talking is that we need to strengthen our underwriting capabilities. We need to assess the customer better. And we can't solely rely on the joint liability or a social collateral for lending. We have to look at the customer's ability and not only ability, but also to intention to pay. I think then only we should lend to the customer. I think that's all that I would like to say at this point of time. And I think in the coming months, uh, for the industry, it will be a great time. Already we are seeing some green shoots, and from the regulator side, from the government side, there is a huge support, and I'm sure liquidity will also be infused into the sector. So I think I'm quite optimistic about quarters to come in future.
Thank you.
That's all from my side.
Thank you, sir. I now request Mr. Vineet Chatri to share his view on the trends and changes in the sector.
Thank you, Shamsi. I'm not going to, I think Siddharth covered it significantly well. I will just reiterate that three or four things. One, as he rightly said, the green shoots are already observed, are being seen. I mean, when I look at and I typically look at very closely what I call as X, or the current collection efficiency, or X bucket, or somebody calls that S1 roll forward from current to delinquent. That number, in a way, is just about probably close to about zero point 0.1 or 0.15 above what it was in the previous March. So it has kind of sharply come down. So the corrected collection efficiencies, barring few places, are closer to 99.6, 99.5, which essentially means that the downward trends towards the slippages was already observed. Now, and therefore, hopefully, as we all see by H2, you can actually see some positive results that may emanate from this industry, because of course it will take its own time to translate into the financials as well. That's point one. Point two, of course, the Karnataka scenario. Tamil Nadu, as Sadaf rightly said, has not seen any significant or any particular movement at the ground level. In Karnataka, things are improving quite steadfastly, but of course, we thought that by June, July, it should come almost to normal. It's slightly, it just probably take about a month or so, but it should come back to normal in about July or so, is what we are all thinking, or all looking forward to. It's pretty close to that. As he rightly said, we have to be careful around Bihar, especially on the eastern UP Bihar side. There are some areas where local activism are creating some sort of a concerns, but it's not very significant. But given the heavy focus, or the larger portfolio in that particular region, that can actually kind of move it a little bit up and down. Liquidity, yes, of course, the MCLRs. Now, most of us, when you borrow, either it's repo or MCLR, it is linked to MCLR, it takes its own time to come down. But to that extent, as he rightly said, there has been a lot of push in terms of opening up the liquidity coffer by the banks as well. Yesterday, there was a fairly interesting comment made by the Honorable Finance Minister herself in terms of the PSL lending and its underutilization. And therefore, there was a big focus on why this can't be done. And it needs to come to the NBFCs who can actually use their reach to use this capital effectively. We hope the message goes. The liquidity, to the larger NBFCs seemingly is coming, it's easing up. Banks are opening up, their mindsets are changing, things are easing out. I think that trickling effect will happen to the to the medium, and then eventually to the smaller MFIs as well. Besides that, I agree with Siddharth that most of the people have actually taken quite significant steps in curing their operating strategies, from going more towards new customers, Rejection ratios have been high. In fact, a lot of people have been saying that disbursements, of course, in quarter 1 are typically slow, but over the quarter 3, quarter 4, you see typically it's a very interesting trend. If you observe, there is a typical U curve that you see in this industry. In the last year, we saw the U curve, and this U curve in the quarter 4 was also not high. In quarter 4, people were also looking at a very, very calibrated disbursements in the last year, in the last fiscal, because people were focusing upon and rejection ratios were high because we were all curing our portfolios. And therefore, when you see the quarter 1, a lot of people compare quarter 1 to quarter 1 or a decline from quarter 4 to quarter 1. One has to itself see what was actually the quarter 4 growth previous year was not also as sharp as it typically is always. So I would rather reserve my comment on that. I would say that let's wait for H2. You will see significantly more established trends with a fair evidence in H2 for this industry. All said and done, this year for me, and I'm sure for the industry, is the year of consolidation, of actually coming back in and creating probably a positive perception. Both the SROs have been steadfastly working towards it. And I'll stop here. I'll say that this is a year where things will turn around for most of the players in the industry. Last but not the least, qualifying asset gives a fair amount of respite. I would only add, while of course on one hand it gives us a lot of chance for diversification of risk by getting into other products, but one has to be careful, and that's my request to all the SROs as well, is to ensure that we just don't kind of create non-qualifying assets out of the same product and kind of avoid the guardrails because of that. One needs to be very careful that whatever we do in terms of diversification is done with the right spirit, right credit underwriting, and the right set of customers. Launching the same product to same customer without thinking may not be a right idea. And while JLG, I mean, I know Sadaf, you said that JLG is changing. I would say microfinance is always about process. And this process is actually, as we speak, and I'm happy, so that practically every microfinance entity has actually moved up on their analytical curve. Somebody is using their own score, somebody is using the outside score, but everybody has used significant amount of analytics, which is going in both in terms of collection, both in terms of scoring, because we all have understood from a point that it's about looking at this portfolio with a very, very different lens. We can't continue to do what we were doing earlier. And that is the time for the change. And I guess every Black Swan event, and this time it was quite deep. There was no helping hand like COVID, which came. This was not a demon where it was different in different region. This was a very, very pan-India impact which happened. It was deep. But every event leaves us wiser. And I hope this time we all have emerged much wiser, and there are probably good times to come in next 1.5 years. I'll stop here. Thank you.
Thank you so much. Yeah, very nice.
Thank you, sir. Now I'll request Mr. Karthik Srinivasan from ICRA to share his view as a rating agency and how he is looking at the sector.
Hi, thank you and good afternoon, everyone. Few thoughts from my side. FY25 has been a very challenging year for the sector. And if you really look at the way financials have played out, not only FY26, but definitely H1, not only FY25, but H1 of FY26 is also likely to see pain before things stabilize and start improving. At the same time, one of the biggest positives for the sector has been the recent relaxation by RBI that MFI qualifying assets can come down from 75 to 60. That definitely brings a lot of change as far as the business model is concerned. But just a couple of things that I would like to highlight, so that you can see how best you want to make use of it. If I just go back, many instances where monoline companies have expanded to other business segments. You have seen MFIs converting to small finance banks. And one of the excitement was I can now build up new products I can possibly add on to the product suite to my existing borrowers. But if you really look at the data, now, a lot of these entities suffered on the asset quality part for the initial couple of years when they moved to other segments. If I was to talk at the current juncture, most of y'all have been very strong on the JLG model. Last year and a half, we've seen quite a bit of change happening on the JLG model, but at the same time, one has not really been able to build a credit skill for individual underwriting. So before one really starts jumping into these other segments, it may be good to sort of pause and enter these segments slowly before you try to make use of the full advantage of the 40% benefit that you have now as compared to past. More importantly, it'll also be prudent to look at what kind of assets, what asset tenors are you looking at. The reason I'm saying that is, if you look at only microfinance loans, what started, let's say, 7, 8, 10 years back was more of a 1-year loan in MFI that moved to 18 months, that moved to 24 months. Today, most of you all are lending in the 2 to 3-year kind of a bracket. Now, one of the segments that we have in general seen people when they diversify is longer tenor products, whether it is LAP or SME or micro SME. These are long tenor loans. The whole mindset of ability to collect from such long tenor loans, the ability of entities such as yourself to avail long tenor loans, to manage the ALM, one needs to factor in all these before one expands into these segments. Coming back to the MFI piece, we do believe that data for Q1 is not really out, but if one was to just look at some of the headline numbers that either the listed entities have been showcasing, whether it is banks or SFBs, it continues to suggest that Q1 is definitely muted in terms of disbursements. Asset quality is also not all that great. And more importantly, when the AUM is shrinking, the percentages look far worse than what it actually is. So from your point, to continue to get access to funds, it will be very important that you showcase that the newly originated book over the last couple of quarters, how good they are performing. That will actually help you convince the lenders that the things that the sector is returning back to normalcy. I think that's something which will be important not only at an individual entity level, but definitely Sa-Dhan can also with its reports showcase some of these things, which will make life a bit easier for the lending institutions to sort of take additional comfort that possibly the worst is behind us as far as the industry is concerned. From an operational level, again, one of the biggest challenges that we've heard as rating agencies outside has been, the workload on the field staff, a partial breakdown of the JLG model, which means that the pressure on the workforce has got significantly scaled up, and that is leading to a lot of churn at the field force levels. So to somewhere, one need to reconcile that till the time the JLG model is sort of coming back, or if that is not coming back, one possibly needs to operate with a lower productivity level or a lower AUM per field officer. So that's what is going to give you sense of stability on the asset quality and consequently the portfolio. And then, that will actually help the industry go forward over the next couple of years. We do believe that possibly the worst is behind us, as Vineet and Sadaf said. Maybe second half of the year we should see signs of improvement. And as one expands and gets into individual lending, whether we like it or not, I believe that the KYC strengthening, PAN seeding is something that one will really have to follow up much more vigorously, at least for our own good, that at least to the extent possible, we are able to do a much better work right at the inception and the credit underwriting part itself. I think these were largely my thoughts. Profitability, while we have seen the sector report losses. Again, a large part of the losses is driven by a handful of entities, but many of them have significantly reduced their profitability levels in FY26. Our estimate is we should see some improvement over there, but it's not going to be anywhere close to FY23, FY24 levels, which were the best years in the recent past for MFI. I think with that, I'd like to close my comments. Thank you.
Thank you, Mr. Karthik.
Thank you.
Srinivasan. Now I'll open this for Q&A session. Requesting audience, if you have any question, you can put it on the chat box, or you can just unmute yourself and say. There is one question from Mr. Sears. How was the Q1 F26 performance for the MFI sector been so far, and how has the sales? Okay.
So I think Karthik, you can. You already said that in your.
In fact, I saw that question when I was talking. So to the extent possible, I sort of covered it. But sir, you might be having far more data at your end. Maybe if you can share your views as well. How have you seen the Q1 for the industry?
See, we also observed that the collections have definitely improved. There is definitely a improvement as far as the collection quarter to quarter is concerned. So things are improving, but disbursement probably still to pick up. And as Vinith already said, generally the first quarter is a quarter where things are a little slow. So we would be seeing better results as we go forward. So as we see the Q1, the collection efficiency has started improving.
Also, he is asking regarding credit cost and operational ROA.
I don't know. Sa-Dhan sir, you have any view on that, Vinithji? In terms of operational collection, ROA and ROE, any difference you are seeing?
So being a listed entity, for me, I'm constrained to talk about my numbers, but I can give you a sense overall. Definitely, and that's just a sense that I'm saying. Collections have definitely improved, but credit cost might not look better because a lot of the impact of Karnataka would be carried forward in the Q1. Entities like us, we had taken the hit in the Q4, so we might not have that much, but some entities may have. So credit cost, I think, may stabilize, as Karthik says, by H2. H1 might see a little bit of impact on the credit cost because of whatever flow is coming. But overall, incremental collection is definitely improving.
So that's all this credit cost. Is it because of the legacy issue also? Is it because of the carrying?
Yeah, so different institutions have different provisions. Some people like to provide for, and some people like to write off, and write off at some people write at 360, some people write off at 180. So whatever portfolio has deteriorated will come for a write off in Q1 and Q2. I think I still believe that the credit cost comparatively would be somewhat better, but not really back to the olden days as of now in H1. H2 might see rationalizing of credit cost, definitely.
Vinith, any view from your side? Karthik, can you throw some light?
No, since this credit cost will continue to remain high in Q1, again, largely because, see, MFI sector is, again, as you said, it's a diverse set of entities, right? From very small entities and not-for-profit companies, right, to the very large listed entities. Not everybody has the balance sheet strength to have absorbed the losses last year itself. So depending on their own ability, they would have taken some of the provisions or write-offs last year. A lot of them may continue to take it in the first half. So the provisioning cost or the credit cost, as we say, that will remain high, at least in the first half. Possibly may start see some moderation going forward. Ratios will again look bad because the AUM will take some time before the AUM starts increasing again. So that is going to be a be a challenge. What we also heard from couple of entities is, while the new underwriting has been good, but the movement from bucket 30 to 60, 60 to 90 and beyond, that pace is still continuing. So which means, some of the legacy loans or loans given 6, 8, 9 months back and already seeing stress will possibly slip into 90 DPD plus in the current year, which means the credit cost will remain high. It's
Right.
two sets of data that we hear. I mean, very early generated new loans are doing well, which are already in the current bucket, seems to be doing well. But those
Right.
which are beyond 30 plus, the movement to the subsequent buckets has not materially slowed down. But again, these are all only anecdotal evidence. We would probably get some more color once the Q1 numbers are out by many of the players.
We have seen that the fresh delinquency has definitely come down. If you see the Q3 of last year and Q4 of the last year, there is definitely a difference in the PAR up to 30. That is the DPD up to 30. The numbers have definitely come down.
That has come down. So beyond 30 still seems to be a problem. That is not coming down as fast as possibly what one hoped for.
So what is the next one?
There was
Something
one
on Bihar?
question on, is there any other issues which can, apart from Bihar, this kind of issues, any other state? What about the negative media?
See, Bihar, so far, not many visible significant issues are there, except for one or two districts. We saw some kind of a activism where we also went and had some kind of engagement with the local team and local administration, but nothing much has significantly has come out of it, only small here and there. But as Sarsab said, or we said, we had to be a little cautious on that. One disturbing thing which is happening or we are seeing is that some kind of a staff mobilization is happening in some eastern region. So probably need to take a little caution on that aspect also.
There's a hard
Right, sir. So any other question?
There is one on funding cost. Is there any chance of change in the funding cost? How bankers and lenders think?
See, as Sadab Saab said, yesterday we had a beautiful meeting with the finance minister where she was quite gung-ho about NBFCs as a whole and microfinance also in particular. And she was very clear that there should be a partnership between the banks and the NBFCs for taking the growth forward. And she was also citing that banks are not able to use their prior to settle allocation fully, and as a result, some of the amount is getting transferred to NABARD's RDF fund. And she was saying that she was advocating that it should be routed to NBFC. So I think from the government side, there was a strong intent as well as kind of an urgency to see that the funding to NBFCs and MFIs should continue and should take growth. So we expect that things would improve. It all depends on the sentiments also. Last year the sentiments were a little bad. Now things would look better. So I think this year the funding will become better.
Thank you, everyone. So if you have any question, you can write to us. We'll answer that over mail. I'm requesting GG sir for the final remarks and vote of thanks.
Thank you. I have nothing more to add. In fact, very clearly, our three speakers have very clearly given their perspectives. As regards the QMR is concerned, a couple of good suggestions have come. We'll be taking that into consideration, and we'll also request everyone to give your views, because every time when we send our QMR report, we ask for the suggestions to improve it, because we would like to go on improving so that things would become better. So next time we'll definitely take into account of the suggestions given, and we'll try to make it improve this better. And if you also have any further suggestion on that, please do it. Please send it to us. As regards the perspective about the sector and its current status and going forward, I think things are looking much better. Everybody is positive about that. I'm sure we will be seeing a much better year this year. So all the best to all of you. If you have any questions, please send it to us in a mail and we'll be returning. Thank you so much. Thank you very much. Thank you so much.
Thank you, everyone.
Thank you.
Thank you, speaker.
Thank you. Thank you.
closing.